Right now, you're not in Clubhouse. You are live on Facebook for the Thursday edition of the Not Your Average Investor Show, Rental Income Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that they call GC because of his genius concepts, because he generates cash flow, because he's a great co-host, and last but not least, because his name happens to be Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
It is great to be with our community today. We got Lee Bishop in the house. Welcome, Lee. We got John Henning in the house. Welcome, John. Eddie Harris. Hello from Hotlanta. Eddie, good to see you, buddy. Leo from California, who's still locked down. I'm sorry to hear that, Leo. I hope we get through this soon. John Evans. Thomas Chapman is back. Miguel Angel Sanudo, all the way from Spain. Wonderful, man. This is amazing. Pratap, he's back as well. Hello from the Cape Cod. Fantastic. Stacy Taggart, a Not Your Average Investor Show celebrity, is with us today. Welcome back, Stacy. She was our guest on Tuesday. Sergio, go Gators. Welcome, Sergio. And we got Don Spafford from Eastern Idaho. All right. It is great to have everybody. We got 46 people on with us today. I hope that you are ready to learn about rental income properties. And as you know, if you are returning, and you may or may not know, if this is your first time, this is the interactive show. This one's driven by you. Gregg and I have completely decided that we're just going to answer the moment questions start. After we introduce the property, we're going to go into questions and answers. So bring your questions. There's two ways to interact with us. Number one, there's the chat. Right? You pop open that chat. There's a little trick. Don, I see you here from Eastern Idaho. You are only speaking to panelists because the default in the chat, Pratap as well, the default in the chat is that you're only talking to Gregg and I. So if you change that little blue box from where you text and change it to panelists and attendees, boom, now you're talking to everybody else. There's a lot of collective wisdom in this room. So we want you all interacting with each other. Don's a quick learner. I like it, Don. You got it, buddy. The second piece is, if you want your question asked on the show by Mr. Genius Concepts, Generates Cash Flow's great co-host himself, pop open that Q&A box that's on the bottom right and put your questions in there. The reason why I asked, Pratap got it as well, quick learner too. The reason why I ask you to use that Q&A is because you're going to see that chat flies, right? Like there's a lot of people on this call. Like I said, tons of collective wisdom. So people are putting in their own input and their own experiences. Feel free to learn and connect and make a friend. But if you want that question, then it stays in that Q&A for me. I don't go cross-eyed looking for everything, even though I am willing to go cross-eyed for you. I promise. last but not least, if you want a basic guide on passive income, go to jwbpassiveguide.com, download that little toolkit that comes with the rental income property of the week. The basis of the rental income property of the week, that spreadsheet comes with it, right? So you can use it to analyze your deals, and you can use that, to go apples to apples for everything that, anything anybody's pitching at you, whether it's JWB or anybody else, all the numbers are there, right? Like make sure that you're thorough, checking everything out. We're going to teach you how to use it today on the show. I get to tinker with it, but without further ado, Gregg, we promise people we're going to answer questions as they come in, man. We got our friend is back, anonymous attendee, puts in on the Q&A.
I think it's pronounced anonymous.
Anonymous. All right. Asking, how do I decide between a recent construction, 10 to 15 years, versus a 30-year or older property, which has more cash flow? Please share your thoughts.
Wonderful question. So that's a great way to kick it off. In fact, Pablo and I kind of make some notes ahead of time, talking points and whatnot, and talking between the difference of renovations and new construction was actually one of the talking points. So, to answer your question, the way to make any decision in rental properties, the first thing to look at is what we will probably look at first here when we actually look at the property is your return on investment, both in the short run and the long run. When we're talking about the short run, we're talking about the effect of positive cash flow. And so we're looking beyond just what is that positive cash flow number. We're looking about that positive cash flow number in relation to everything else, right? How much did you have to pay for the property? How much are your other expenses and whatnot? So we're going to look at that return on investment from the cash flows. And then we're also going to look at what's your return on investment if you hold on for a full market cycle. Once you hold on to a full market or for a full market cycle, that's when you can start to include home price appreciation into your calculations. And so to answer your question, between a renovation and a new construction, specifically here for JWB, I love them both. I have them both in my own personal portfolio. We sell both to clients. And as I mentioned, we love them both. And why do we do that? It's because we can find new construction and we can find renovations that both fit into that 9 to 11% return on investment from the cash flows. And when you factor in home price appreciation, both should appreciate at the same rate given a full market cycle. And that's why we love both. So when you're thinking about it for yourself, I would really use the property evaluation tool that we have. If you go to JWB Passive Guide, that can be your tool to use. And you can take whatever properties you're looking at, you can plug it right into this tool, just like we're going to do on the property of the week. And this is going to give you an apples to apples comparison that I think will really help.
You know, Gregg, as I am the voice of the customer on the show, when I hear you answer that, I hear you answer it from a standpoint of, you know, that your team is able to deliver high quality in a reno or in a new construction. When I hear that question and I hear 15-year versus 30-year, maybe Anonymous is concerned about what kind of updates you would need in a 15-year property versus a 30-year property. So maybe you can answer it from the perspective of, what are the deal breakers that you know need to be really, really intact to go into a rental income property, knowing that your maintenance is going to reduce?
That's a really good point. So when I'm answering that question, I'm coming from the JWB standard way of thinking, which is not normal if you're going outside of that, right? There is a very big difference between how normal renovations are done versus the JWB standard. And I would say that there's a very big difference between how normal renovations are done, not JWB renovations, and then new construction. There's a wide range, right? So I really appreciate you bringing that up, Pablo, because I'm in JWB world right now.
Yeah.
So in JWB world, our standard is to make sure that there's not deferred maintenance. That's really what you want to avoid. Many times, maybe if you're doing a renovation yourself or if you're going with another provider, especially in an environment like today where inventory is really hard to come by and it's hard to make the numbers work, there is more of an incentive to not do some of that additional work done for a renovation. It is very real out there in an environment today, whereas it wasn't as hard to make the numbers work 5 years ago for turnkey rental property providers. So what you want to do, that standard really needs to be number one, that you don't have deferred maintenance. Deferred maintenance would be major ticket items that you know you're going to have to do in year 2 or 3 or 5 or whatever. Major ticket items would be your major mechanicals, right? Your roof, your electrical, your plumbing, right? Making sure that those items are to that standard, almost to the same standard of how a new construction home would be, right? If you go in, like for example, for JWB, our average renovation is $42,000 when we go and we renovate a home. Now, the average square footage for the houses that we invest in, I don't have it right in front of me, but probably about 1,300 square feet, right? It's hard to put $42,000 into a 1,300 square foot home unless you are replacing a lot of the major mechanicals or at least making significant upgrades, right? And so that's that standard that we have. And that's what I would encourage all of you to hold yourself to if you're doing the renovations, or hold that turnkey rental property provider for you. Make sure your major mechanicals are in place. And after the major mechanicals are up to the standard, then make sure that the house is going to rent well, right? This doesn't need to be the best looking house on the block. It doesn't need to have, it doesn't have to pop when you go inside the house. It needs to be at the standard of what is going to rent very quickly. So you need to look at other homes in that area that are for rent and make sure that your home is at that standard or a little bit better. And then your homes will move very quickly. There
you go. Great value, buddy. We got 3 more questions. Let's knock these out and then we'll put on, because I think we're going to talk a lot of good stories of this stuff with this property that we're putting in, right? Like I'm hearing a lot of the themes that we're going to want to hit on in this property, but let's stay true to what we said. This is the crowd generator show. Thomas Chapman, welcome back, Thomas. He asks, how much does it typically cost when a 2-year lease expires and a new tenant is found?
That's a great question. So thinking about it from an investor's perspective, you want this idea of a of renewing a lease to be this incredibly positive experience for you, right? Because it should be. This is one of the best things your property manager can do for you to hit your overall return on investment. A bad thing would be if a property manager has a big lease re-sign fee, right? I mean, part of the real value here is when you renew a lease that you don't have to pay as much as you had to pay to place a new tenant, right? Tenant placement fees, generally about a month's rent is what you're going to find. Well, if you go out there and work with a property manager and they charge you that or something similar to that, it's going to make it not as fun to have lease renewals, right? We want to go into this as a positive return on investment experience. So for JWB, and this is something that I would recommend, doing business with other property management companies that have a similar pricing structure. It only costs $200 to renew a lease for each year that we renew the lease. So significantly less than what it would cost to put a new resident in place. A new tenant placement fee is equal to 1 month's rent, which on average is about $1,200. So only $200 for every year that we renew. So we renew 1, 2, and 3 year leases. So it will be either $200, $400, or $600 to renew. And that's just one of the buckets of huge cost savings for you as an owner. Like, you guys should be so fired up to get lease renewals, right? So we talked about the cost savings as far as your tenant placement fees versus lease renewal fees. That's a huge win. If you don't have to renew the lease, you don't have vacancy costs, which is lost rent that you're not getting. Let's say it takes a month or maybe even 2 months, right? That's what? Maybe $1,800 on average of lost rent that you didn't receive. You don't have to experience that because we renewed your lease. And then the other thing that people need to keep in mind is that when a resident leaves, there's work to be done in the house, right? Sure, it's possible that there's not, but I'm telling you, there probably is. And it's probably going to come out to about a $2,500 expense for you to put the house back into great rental shape. So you're saving, if you total all of that up, you're saving over $5,000 in real money hitting directly your bottom line if you can work with a property manager who focuses on lease renewals and achieves them at a really high rate. I'm coming out of our business planning meetings and coming out of our quarterly manager meetings, and JWB set a new record last year in 2020 for lease renewals. Our goal was 70% of leases that come up were renewed. We hit 71% of leases renewed. Best we've ever done. And there were a few challenges in 2020 that we overcame to do that. So super proud of our team, and something that I hope you guys really spend a lot of time looking at when you're thinking about a property management company that you choose to work with.
What was it on a show that somebody was like, man, I was talking to another property manager and they said that their goal was like 20% and they never hit their goal? What was that story?
It was one of our teammates. So she just joined our team, I think maybe 2 months ago, and she's on our property management team, and she has been crushing it. In our team meetings on Tuesday, she's getting core value call outs. It's Ashley for any of our team who is watching right now, or any of our vendors or even current clients. So big ups to Ashley. So Ashley stops me in the hallway and she says, Gregg, I went up to her and said, hey, you're doing a great job. Congratulations. I'm hearing your name all the time in the meeting. And she says, you know what? I'm just so blown away. She's like, I came from another property management company. She's like, do you want to know what our goals were? And, I said, well, I would love to hear what the goals are. I have a hard time of getting an understanding of what property management goals are out there, because very few property managers actually track lease renewals or actually set a goal. So what are the goals? And she goes, well, our goal was 20%. She said, do you know that one time we hit 23% and everybody went out to the bar to go and celebrate? I said, you've got to be kidding me. She goes, I'm here at JWB and we're renewing 71%. If you had asked me if that was even possible before, I would have told you it would have been impossible. She's like, I'm so loving being here, and it's just totally changed my idea of how this could be done. So I thought that was a really fun experience.
Dude, that's incredible, man. That's super cool. All right, man. 2 more questions, and then we're going on the property, and then we're going to hit all the other questions. Aaron Cohen. By the way, I hope I'm pronouncing that well. Cohen. All right, Aaron, let me know in the chat, please, because I hate butchering people's names. Aaron Cohen, I'm going with that one. Have you found it easy to transition properties to LLCs after you've already purchased them?
Yes.
Okay, cool.
It is easy. You have to work with a company that has experience on how to do that. I would encourage you to reach out to my team, Aaron. We have extensive experience. I've done this literally hundreds of times with my own properties as well. So there is a way to do it. There are also some risks that you just need to be aware of. So make sure you talk to my team, and it shouldn't be a problem.
All right. The correct pronunciation is a run, go win. I like it, Aaron. I'm in. All right. Let's go win one for right here. Miguel Angel Sanudo has a question. What about properties with fixed expenses, for instance, like HOA or septic versus no fixed expenses? How do you consider those?
I think that's a wonderful question. When you're looking at your return on investment, it needs to include all of those expenses. And again, this is something, I really recommend using our property evaluation tool because there's an opportunity for you to put all of those expenses in. It's very rare that, especially turnkey rental property providers, to put all of those expenses in. Many times, if it's a septic tank, generally it's going to have a few more points of maintenance, meaning a higher percentage of maintenance costs. Very rare that you see that. And closing costs are another thing that's avoided. So anyways, to get back to your question, Miguel, is that you have to take that into account. So if our goal is to be between a 9 to 11% return on investment from the cash flows, and we're investing in a property that's on septic, or that it's has a small HOA fee, what we are saying is that deal needs to be a little bit better for us to still maintain that 9 to 11% return on investment, right? If the rent is this, the purchase price needs to be a little bit lower than if it didn't have a septic tank or if it didn't have an HOA. And so I would highly encourage you to take that into account and make sure that you're evaluating that so that you are making the best decision. Now, when you do that, I think properties with septic tanks are great. I have many in my own portfolio. You just have to make sure that you are evaluating that in the beginning. Again, the same thing with HOAs. You'll find, I don't know, I'm going to ballpark it, maybe 15% of our properties have HOAs. And so those are great as long as we can still hit that 9 to 11% return, which we do.
All right, Gregg, we got a couple more questions, but we're going to pull up the property because I want to get to it before we got 10 minutes before the hour, because as we've talked about, there's been the streak of investors being on this call, seeing the property of the week, and all of a sudden it's sold before they can actually put an offer on it. So without further ado, we're going to reveal the star of the show today. It is 1011 Westbrook Circle, Jacksonville, Florida, 32209. Purchase price, $123,000. 3-bedroom, 1 bathroom. It's got a driveway for a parking. It's got an estimated rent range from $850 to $900. We're going to talk about that, little spoiler alert. But again, what you spoke about, Gregg, what you are looking for is this. The estimated conventional financing total monthly cash flow is $180 per month. And the estimated conventional financing total ROI is 10.31%. Gregg, talk us through that monthly cash flow number. What does that mean?
Monthly cash flow is what you should expect on a normal month as an owner of a rental property. This is that positive cash flow that you will be receiving. And this is taking into account your rents that are coming in and then subtracting out the normal expenses, right? The normal expenses would be your principal payments, your interest payments on your loan, your property taxes, and your property insurance costs, and your property management fees, your monthly property management fees. That's what a normal month looks and feels like for you as an owner of this property or rental properties in general.
Okay, I'm getting some messages here that the text is pixelated.
Yeah, I'm seeing that too.
Let me know in the chat. Is it looking better right now? I just zoomed in some.
It's not, but you know what? I might be able just to kind of bring it up on my side here, and then do the screen sharing on my side.
Well, let's give it a little bit more time. In the meantime, Gregg, right now we're talking numbers, right? Tell me about that estimated conventional. So you said the cash flow number is the typical month. That is what you're putting on in your bank account, 180 bucks, right? What is that? What's the difference between that and the ROI of 10.31%?
So 10.31% is that return on investment that you need to evaluate, kind of go back to an earlier question. That's comparing apples to apples, taking all of the good things and all of the bad things that go in on a monthly basis. And by the way, it doesn't look pixelated to me here. So there we go. We're getting some positive response there. So that's excellent.
That's the old tech trick of kill it and start it over again,
there
right?
You go.
It's like
Nintendo back in the day, right? You took the cartridge, you just blew in it, and then it worked.
Yeah, I did.
So 10.31% takes all of the good things and all of the bad things of owning a rental property. What would be a good thing for a rental property on a monthly basis, Pablo?
Principal pay down, getting my tenant to be paying down the loan that I took out for me.
There you go, right? That's one of the profit centers that not a lot of people think of. Right? That is a profit center out there when you're investing in positive cash flow rental properties. And one of your expenses includes the principal that you're paying down. What's happening is that resident is paying the loan for you, and the loan that you owe is now dropping every single month. And so you do this consistently every single month, and that's how you wake up in 10 years or 15 years or 20 years with the loan potentially being paid off. And that's incredible. Another way of saying that, and this is one of the reasons why I love rental properties, is that even if the market doesn't appreciate and you invest in positive income rental properties, your resident paying your loan down means that you have an equity spread that is growing every single month, even if properties don't appreciate. So it's a big profit center, a hidden one. Let's keep going down the line, Pablo, since you're crushing it. What's another good thing that happens with rental properties?
I'm so nervous. All right. Principal pay down. There is tax deductions, right? There's depreciation.
Yeah. Tax savings. So this is the money that you don't have to spend on the income you're earning from the positive cash flow. And rental properties allows you to take deductions that other asset classes do not allow you to do. And so there's an easy way to calculate what your tax savings is. That's another profit center for you. What's another profit center?
Well, we said cash flow. We said tax deductions. Or tax savings. We said principal pay down. I know that appreciation is one, and we're going to get to that. But am I missing one in there? I know inflation hedging is there, but that's not included in this ROI, is it?
No, you're right. I was going to go down a little bit more of a detailed approach to the positive cash flow, the net rental income. So for this one, this is different than just what a normal month is. So we're taking into account the net rental income, which means your gross rental income, the rent that you earn every single month, minus your principal, interest, taxes, and insurance costs monthly, minus your monthly management fees. That's kind of like what a normal month is that I was just describing before. But we're also taking into account other costs. So your expected maintenance costs, your expected vacancy costs, we're taking that into account. That lowers your return on investment. We're also taking into account the full brunt of a tenant placement fee, which is interesting. Again, if you want to compare this to how other turnkey providers present their properties, many times, in fact, I haven't seen one that actually encapsulates the entire full month of tenant placement fees into this calculation. Saying this another way, it would be very easy for me to put a fraction of the tenant placement fees in there and then instantly bump up this from a 10.3% return to much higher. But we don't do that because you actually do experience that in year one. You get a full month's tenant placement fee that is taken out of your returns, and that's why we do it. So anyways, taking all of that into account, all of the great things of the rents coming in, minus the expenses that we just talked about, minus maintenance and vacancy cost, minus tenant placement fees, and you take all of that along with the tax savings, the principal pay down, and you put it over your initial investment. And your initial investment is your down payment plus your closing costs. And that's how you get that 10.3% return on investment.
All right, Greg, I'm gonna pop in a couple of clarifying questions here before we move on to why it says 0% appreciation rate here. But I look at this picture, right? For those of us that are listening in the future in their ear in a podcast, for our friend that is in this conversation with us right now. Is this property already rehabbed, Greg? Because here it looks like it may or may not be.
This one is renovated and rented. And I'm glad you asked, because here's another thing that you guys should realize. Once your home has been rented for a couple of years, it's going to look something like this, right? It's not going to look brand spanking new. It's not going to look like it does just after a renovation. So this is one that we actually have purchased through our relationship with another company here in town called Heritage. You've heard us talk about this, and it's one of the 4 ways that we secure inventory. And so this is an example where we were able to buy a property from Heritage where the resident is already in place. And so this home has been rented. It has a lease in place through the end of 2022. So it's a long-term lease. And there's some other really fun things to talk about that I won't spoil the fun here, but yes, to answer your question, it has been renovated and it is already rented and positively cash flowing at day one. Now, I guess I'll kind of tee us up for something here.
Yeah.
I think a great question would be, and maybe I'll ask you, Pablo. All right. Now, does this mean that the house has been, just because it's lived in, does this mean that this house has been renovated to the point where it meets the JWB standard? What do you think?
Well, I happen to know the answer to this question, right? But I'm going to frame it in this case. Don Spafford actually asked, does the price already include the rehab cost, or is it $123K plus $40K to update? So you've just answered the fact that no, this house is $123K, right? Because people are living in it already. It's already rented. There is no extra fee in there. But I happen to know that your deal with Heritage, because this is the house that I'm closing on. Actually, I'm supposed to close late next week now, right?
Oh, nice.
Yeah. I happen to know that these Heritage homes, when they have a renter in them, you guys come in and you have somebody make an inspection and you decide that whatever you would have put into this house for the next turn, you give the investor a credit. So why don't you explain that a little bit better than I did?
Yeah, exactly. So when we have this opportunity, we have this home, which is a great performing asset, and it has a resident who has already signed a long-term lease. The first thing we do is we look at the quality of the resident. Does that resident meet the JWB standard? In this case, yes, they do. So that's excellent. The next thing is we're looking at the property. Does it meet the JWB standard? Maybe, maybe not. Well, in this home, what we determined is that it is a great home. We want to manage this home. We have a great resident in place. They have a long-term lease signed. And so the best thing we could do would be to come up with a solution here where that resident can stay. This can be a positive cash flow asset for the client who purchases it. But we can also make sure that this gets to the JWB standard. And we don't want to ask this resident to leave for a month or whatever while we would go in and renovate it. So the solution here is that we do an inspection. We understand what we would need to spend that we would have spent anyways to bring this up to the standard. And then we give that as a credit to the buyer who purchases the property from us. So that credit happens to be $4,800 is what we would have spent on items in order to renovate it to our standard. And so for you as the client who might be thinking about purchasing this one, this is an incredible opportunity, because if you look at your expected maintenance costs, the majority of your maintenance costs do not come while your home is being lived in. The majority of your maintenance costs that we've already told you to expect and built into the evaluation comes from the property turn, right? If there's a flooring issue and we have to replace flooring, if there's paint issues or whatever the issues would be. So now this client who purchases this home, right? You got to look beyond what you just see in this picture, right? You see it's maybe that awning right there looks a little dirty to me, right? Part of that is that's just real. When you own a rental property, eventually it's going to look that way. But for the person who's purchasing this, if you're looking at the return on investment, you have $4,800 that's now going to go to your first property turn. JWB is going to give you that credit at closing. And so if your average property turn cost nets out a cost to you of $2,500, and you already have $4,800 coming to you that can be used on this property turn or any other maintenance items, the chances of you having a big pop, meaning a big expense from your first property turn, is much smaller here than anywhere else. So we look at this as a great way to create a win-win-win, right? So win for new inventory. It's a win for the resident. It's a win for the client. And of course, if we do that, JWB is going to win as well. And that's how we would do this.
I love it. Always looking for the win-win-win. All right, Gregg, let's talk about appreciation. Why is this at 0%? Let's give this one last canned lesson that we always do, and then let's just go straight into everybody's questions.
I never get tired about talking about this. This is a core fundamental opportunity within rental property investing that most people just don't get. So I will sing it from the rooftops as many times as you guys have given me the opportunity to sing it. So when we're looking at a home price appreciation, the reason you're probably interested in Jacksonville is because you've done research or you've talked to somebody and you've kind of understood that Jacksonville historically grows and has more home price appreciation than the national average. Actually, since 1991, we have 19% more home price appreciation here in Jacksonville than the national average. And so we are what's called a growth market. And you would think that we would put that home price appreciation rate in our standard evaluation, but we do not. You see 0% there. That does not mean that Jacksonville is not a growth market. It just means a couple of things. Number one, in order to evaluate home price appreciation, you need to be investing for the long haul. And I hope that you invest for the long haul like I do. I hope that you listen to what's going on this show, but not everybody does. And so if you do not invest for a full market cycle, I think home price appreciation is speculative, and I would not count on it. A full market cycle is known to be between 10 to 20 years. And so the reason that this concept makes so much sense, and the reason that I hold on to my rental properties for a full market cycle or longer, is because I'm looking at the total potential return on investment. Once you start to plug in home price appreciation based on your local market's average over the long haul, your 5 profit centers come to play and your returns on investments skyrocket, which we'll look at here in just a second. But if you do not invest for a full market cycle, you can't do it. Okay. So the theory though is that if you look at historically what your market has appreciated at a rate, since 1991 is where I go back to. That's what the data that we have from the Federal Housing Finance Agency. If you go back and you look over 10, 15, or 20 years sections of time, what you're going to find is that same rate or very close to that has been repeated over and over and over again. That's why it's called a market cycle, is because history repeats itself as far as home price appreciation, as long as you give it 10 to 20 years in the property. So Jacksonville's home price appreciation since 1991 is a rate of 4.3%. And assuming that you're going to hold on for a full market cycle, you can expect something around there for your home price appreciation.
Done. Put in 4.3%. I just press enter. Kicked into gear for the spreadsheet that you can download at jwbpassiveguide.com. And now our ROI just went from 10 point something to almost 26%, Gregg. Like I love this little magic trick showing the power of leverage. Maybe you can just kind of quickly detail why such a big jump, and then we can get into questions here.
Yeah, absolutely. So very quickly, if you are buying a property in all cash, that home price appreciation would equal what your return from the appreciation is. Meaning, let's say that the value of the home was $100,000 and the market value went up 4% that year. You would have earned $4,000 and you would have earned a 4% return on that investment because you put all $100,000 in. The beauty of leverage here and using smart debt, smart leverage is that in an appreciating market like Jacksonville, you can get a much higher return from home price appreciation. If you are only putting 25% down, but you're getting a 4% return on the market value, you're actually earning a 16% return from the home price appreciation. And if anybody wants to kind of do the quick math, just take your cell phone out here, grab a calculator, do 4% over 25, right? If you are earning 4% and you only put 25% down, then you're going to see it's a 16% return from the home price appreciation. So you add 16 to the roughly 10 that we had before, and that's how you get roughly to 26 like we see there.
There you go. It's not magic, it's math-gic. All right. So we're back to Anonymous. Welcome back, Anonymous. Anonymous Attendee says, do you see differences in rental turnover by rent rates? And I think this is where we can talk about the uniqueness of this rent rate here. But why don't we answer that first? Is there a magical number in the rental rent range that you see turnovers get affected?
We do not see a difference, but part of the reason that I can say that confidently is the reason that we only invest in certain neighborhoods, right? If we were investing in places all over Jacksonville and there was different demand from renters at different neighborhoods, we would see different turnovers. We would see differences in how long of lease signs. We would see differences in average duration of tenant stay. But we do not see that. We only invest in 4 neighborhoods in Jacksonville. We do the same thing over and over and over again. And so these are neighborhoods that have significant rental demand because you need that. You need significant rental demand to make sure that this model works, right? There's a split of homeowners and renters, but we want to make sure that there's significant rental demand in those neighborhoods. So we do not see a difference. We don't see differences in the properties that rent for $1,000 a month versus the ones that rent for, $1,500 a month, because there's really not a huge span between the changes or the variation in rents.
Yeah, that makes sense. And the other thing that was a big aha moment when you explained it, and it was kind of when COVID broke, you explained the fact that once you get into a higher price of home and a higher rent range, now we're talking about homes where people have an option to move up and buy a bigger house and rent a bigger house. And therefore, that means that part of that money that they're spending on rent is money that they're deciding, do I spend this on rent because I want an extra room and I want to live close to the beach? Or do I put some of this stuff in the stock market or in some other investment and rent a cheaper home, right? So like the idea that where you're at, your hedgehog, right? Like your formula for exactly how it performs, being in a certain price level, a certain income level, a certain neighborhood type with a certain proximity to jobs and job profile and demand and price point, being that giant insulator of demand makes a ton of sense to me that way.
Absolutely.
Yeah. So that being said, something really interesting happening in this rent, right, Greg? You were telling me that you want to talk about this. Why don't you tell them what's going on with the rent here?
There's a lot to like about this investment property, in my opinion. We talked about the fact that it's positive cash flow from day one. We talked about the fact that it has a 2-year lease in place. We talked about the fact that it has a property turn credit of $4,800. These are things that really, really should matter to you as an investor. We talked about the low purchase price, right? You can buy this one for lower out of pocket, lower than $35,000 down, which is unique, right? There's a lot to like about it. So I was getting excited about choosing this one to highlight for you all. It's also available, which is really cool. Little sidebar: when Pablo and I started doing this show, we didn't know how it was going to go. So the simple fact that folks have been calling the office or reaching out to the office after the show and saying, hey, I'm really interested in this one, and it hasn't been available at that point, and we may have frustrated a few folks. That was something we certainly didn't intend to frustrate, but kind of like we're like, wow, this is really cool. So I appreciate all of you for being here and for being so interested. There was a lot to get excited about. There was one thing that I thought we made a mistake on for this property. And between my business partners and I, like if I catch my business partner, Adam Eisman, who's our CEO, making a mistake, it never happens pretty much. So I was like really excited about it. So I sent him an email. I was like, buddy, I looked up on the property in Westbrook. I said, I looked at what the rent rate is right now. It's $925, but we've got $875 on the evaluation. What's up, man? Did you make a mistake? I was hoping to get him a little bit. And he's like, Cohen, you still didn't get me, buddy. So what he explained to me is that this home is rented on a long-term lease, but we have extensive knowledge of that area. And we really feel that the market value for that rent is really between $850 and $900. And so when we go, again, this one has not been sold, right? We go again to make this available for clients. We go ahead and we put $875 on that evaluation, even though actually right now the lease is for $925. I don't know of another provider who's going to do that, but it's because one of our core values is to under promise and over deliver. And we want to make sure that at the end of the day, we are very, very concerned about hitting your return on investment goal. The one that we set out there, that 10.3%, is what we need to hit. It's what's going to be shown to you every single month in your reporting. You're going to see the fact that we told you 10.3 is what we needed to hit. And so when we see something that is over rented, we're not going to go out there and put, 925 on the evaluation, because we're not sure that the market rent there really sustainably is 925. So, for just this example, Pablo, if you would go back and you put 0% in for the appreciation rate, just to get us kind of back to square one.
Got it.
And then put 925 in at the rent, right? I'm just kind of showing you kind of like behind the evaluation. If you're a turnkey provider, right, and you wanted to make sure your returns were as high as possible.
I think I put in the wrong thing.
Yeah, you did. Go ahead. 925 there. Perfect.
There it is.
So many providers out there are so focused on showing you the absolute best possible way that they can produce a really high return, right? We put it at 875 and the returns are 10.3. Actually, it's rented right now for 925. Another provider would put this out there for 11.6%. And they wouldn't include your tenant placement fees. And they wouldn't include closing costs. And they probably wouldn't put the maintenance percentage as for what we know it to be, right? So my point here is that you need one tool to evaluate apples to apples. Because if you take other turnkey providers' evaluations and you just go by them, I guarantee you're not going to know all the tricks that they can use to manipulate the data. And ultimately, it can leave investors in a place where they are promised more and then delivered less. And that's unfortunately what's held back our industry for a long time. It's why more people are scared about investing in rental properties. So
that makes a lot of sense, man. That makes a lot of sense. And it goes back again. We started this call talking about our morning run and your core values. And you really, when we were kind of like going into it, you're like, my number one core value is to under promise and over deliver, because you're so focused on that micro moment client experience that, that even though that you can hit grand slam home runs, you like to promise doubles and feel real comfortable that you can generally hit a triple, and every once, like very often hit a home run, and often enough hit a grand slam. But either way, you are setting people up to have a good experience based on expectations. So I think that's really, really cool, man. So if you want to get this sheet, go to jwbpassiveguide.com and you're able to account for all the things. I'm going to put this back to, what was the actual rent that you said?
875.
Yeah, I just had to Control Z that sucker real quick. All right, there you go. Okay, now we're back. All right, now let's get into user-generated questions from here on out. Pratap Bandari asks, hey, Gregg, I want to expand my portfolio with you in Jacksonville. I'm a little tight on liquid cash right now. I have some 0% interest business credit card. I can pull some cash. And I have some properties with equity in it. What do you suggest how to invest with your company?
Well, hey, Pratap, thank you so much for being here. What a great question. And it's a question that many folks, I'm imagining, on the call here and definitely in our client and our group of clients have similar questions. There are a lot of opportunities right now for those who might not have the capital in hand to, I won't say it's necessarily creative strategies, because that has a little bit of a negative connotation, right? We're not going to get into no money down deals or things like that, but there are other resources that you can use. The first one that comes to mind would be a cash out refinance of the equity that you have in the other properties. This can be an absolute grand slam for you, because we're in an environment right now where interest rates are so low. And if you have some equity in these homes, credit for those who can qualify is readily available, right? So what you may be able to do, Pratap, is to refinance the existing homes that you have, be able to pull out enough cash that you have for a down payment for your JWB properties, and potentially keep your payments the same, because you might have interest rates that are on those other properties that you're refinancing that are higher than what you could get today. In fact, I would probably imagine that that's the case, because interest rates right now are the lowest in history. So we have a lot of clients who purchased homes from 2010 to 2015 who have a lot of equity, who had interest rates maybe around 5% that they were paying on their loans. And they also have goals that would dictate they need to add 2, 3, 4, 5 more properties. So they're able to go and refinance. We're able to help them refinance, pull out that cash, and then acquire these next homes. And then they're acquiring these next homes, these 2, 3, 5 homes with interest rates at like 4%. And as we've talked about, you and I, Pablo, and Rich Ritchie was probably the first guest that really kind of espoused this, is the deal right now is the debt. The deal right now is the debt. The ability to secure these assets and to only pay 4% interest on the loans for the next 30 years is the deal. So you'd be setting yourself up on these future purchases as well. So that's the first place I would look based on what you just shared with me. But I would imagine there's others, Pratap. So I would certainly encourage you to sit down with my team. This is what we get to do. We get to talk with you about your plan, your goals, the resources that you have. And believe me, we manage about $450 million of rental properties here. And so we're going to have some ideas for you even beyond that.
Cool. So I put it in the chatwithjwb.com. If you want to schedule a call with the team, they can walk you through that. Pratap, welcome back, by the way, Pratap. I recognize you coming back week after week. Good to have you, man. Mike Foster, who's another guy that comes back week after week. Welcome, Mike. And I'm going to read this verbatim, just so you know. Each week, when you show us a JWB property of the week, those property spreadsheets show a projected conventional financing ROI of somewhere between 9 to 11%. Wouldn't it therefore make sense for an investor looking to buy one or more JWB properties to request to purchase only those properties projected to produce the higher ROIs, such as 11% or higher?
That's a great question. So I think what Mike's saying is, if we're trying to get between 9 to 11%, would it make sense to only purchase the ones that were at 11% versus the ones that were at 9%? Well, I think if everything was held constant, my belief is you look to return on investment first when making decisions. So if you held everything else constant, Mike, then yeah, you'd be right. Now, in reality, there are other things to take into account. Number one, I guess the first thing that I would share is that when you're looking at these returns on investment, right, we need to understand that this is going to be held for 10 years, 20 years if you invest like me, right? I've got the evaluation right here that I'm looking at, right? It's 10.3% return. Now, do I actually think that it's a 10.31% estimated return on investment? Now, after holding on to this for 10 years, do I actually think that we're going to sit down with you and actually produce a 10.31% return on investment on the dot? No, that would be highly unlikely, right? I think we're probably going to produce a little bit better. That's been our history. Right? It's not going to be 10.31% right on the dot. And so most of you probably, that's not an earth shattering, right? That's not an earth shattering little nugget there. But at the end of the day, what I hope you guys realize is that within a small kind of margin here, these properties are generally about the same, right? Call it a half a point, right? Somewhere around there. The homes are generally the same. Would I get so much more excited about a 10.3% return than a 10% return? No, I'm right. After 10 years, you can kind of see the difference there. So I wouldn't get so specific and say 10.31, I'm definitely doing that one versus a 10.2 or a 10.1 or a 10%, right? It's very similar, but there's a lot of other things to take into account. If we can put homes in front of you that are already rented and positively cash flowing from day one, wow, that's a big opportunity, right? If we can put homes in front of you that already are rented with a 2-year lease in place, would I take that? Maybe if there's a 9.8% return versus a 10.8% return, maybe I take the 9.8% that has a 2-year lease in place that's already cash flow positive. If I can look at this one and say, well, there's a $4,800 property turn credit, would I take that into account and maybe buy a 9% property versus a 10% property? Yeah, probably. It would certainly factor in for me. If I'm looking at this one and you're talking to my sales team and we share with you, hey, listen, this is rented at $875. That's your expectation, but I've got to share with you that that's the expectation for rent, but it's actually rented at $925 right now. Should we take that into account? Yeah, absolutely. So, and there's other variables as well. So there's little minor things that through the process of working with my team, we're going to find the best overall return and the right property for you. And we would certainly take that take all of these things kind of in totality when recommending for you.
Beautifully answered, Greg. I'm going to answer this one real quick for Pratap, who's asking how much the down payment is. In this same sheet, we were before in the summary. I switched over to the analysis convention tab. At 25% down payment, the down payment is $30,750, but you can always go in there and put 20%. For example, I put 20% down on the home that I'm investing in that I should be closing on next week, and it's $24,600. So wanted to share that real quick and move on to the next one. Baby Meekins or Babby Meekins. I'm not sure if I'm pronouncing that right, Babby. Feel free to correct me. How does the improvement credit work? Is it held on account with JWB or does owner manage it? When the house turns, how is it determined what improvements are needed?
Great question. So the way that this actually works is that home has been inspected. And so we have our report of the things that we already are going to fix based on this inspection report. And that's totaled up to $4,800. So, and I took a look at it ahead of time. We're going to install vinyl plank flooring on, these are a couple of the items. We're going to install vinyl plank flooring, which is a hard surface in the home. I would assume it has carpet in there now. And so we're going to cover that cost. That's a part of the $4,800. We're going to install a new shed. There's some door hardware that we would do differently. These are just some of the items that make up that $4,800 cost. And this is all shared with you, before the purchase. So that's there. It's on record of what we're going to fix. Then the numbers of it, the $4,800, JWB holds that in escrow for you, right? We hold that set aside. It's not in the JWB bank account. We pay for it right now. It's in a separate bank account with our construction projects, and that money is set aside. And then we call it a property turn credit because that's where I expect most of this expense would come and would be spent on. But actually it's maintenance costs that would come at any point along the way. So any maintenance costs along the way would actually come out of this $4,800 cost for you. And then once that $4,800 is exhausted, any additional cost for maintenance or a property turn would of course be on you, which goes into that expectation that we have for your maintenance costs in the evaluation for you. So that's how it works.
All right, great. Greg, I know you got to go at 1:30 because you're in the middle of quarterly manager meeting. So I'm going to try to squeeze in 2 quick questions. One is from Lee Bishop, MVP of the Not Your Average Investor Show. Greg, is this home one that was in yours or Alex's personal inventory? Go quick.
It is not. We purchased this through Heritage, which is a relationship we have here locally.
There you go. Margaret Smith asks, regarding the $4,000 worth of maintenance or improvements that would allow the house to meet your usual standard, if I would rather put the cash into the home, could I choose to have Heritage just go ahead with the work for a total of $4,000? We shouldn't be talking huge disruption to the tenant, right? Wouldn't the tenant be interested in living in an improved property? Or is this all, say, internal painting? I guess that would be a pain in the butt for the tenant, ...
Yeah, you kind of answered your own question there towards the end, right? It would be preferred for the resident. It would be preferred for you as the owner. It would be preferred for Heritage, and it would be preferred for JWB. Everybody would win if we do it the way that we've prescribed, right? These are, you've got to put yourself in the shoes of a resident. They just signed a lease to rent this home for 2 years and paid what we have determined above market rent to do it. So this home is great. They like it. And so to ask them to leave to replace vinyl plank flooring right now when their flooring, I'm sure is fine. It's just carpet, right? That wouldn't be the best thing for your resident. So no, we could not do that. It would need to be the way that we've kind of talked about it here.
All right, we got a little bit more time to squeeze one other one in. Greg, you mentioned 4 ways JWB secures inventory, one being through the partnership with Heritage. What are the others?
Well, the first way is we build our own homes, so build new construction. Second way would be renovating our own homes, meaning that we purchase the home, we then renovate it, and we bring it as a cash flow positive opportunity for you all. The third way would be in our own personal inventory. When I say personal, I mean company inventory, right? My business partners and I have our own company inventory. It is in the exact same neighborhoods as the ones that we sell to our clients. We've been building this up since 2006. We have over 300 rental properties in our own portfolio. And we actually have well over 300. I say over 300 because that's what I expect I kind of give it some buffer. It's actually about 380 properties that we have in our portfolio. And that's good to know that in the event that we would have a huge run on sales, which we have had in recent months, that we have another bucket of inventory that we could make available for a client if we need to. Generally, we don't have to go there. And then the fourth one would be relationships and partnerships that we have in our community here with other very reputable real estate companies. Heritage is one of them. We have a couple of others. And that would be properties that we purchase and then resell to our clients. Again, bringing up to the JWB standard, doing whatever we would need to do to make sure that it's a win for the client in the long run. And examples of that you've seen would be this $4,800 property turn credit that we would do in the case of this property. And it's very similar. That's the same thing that Pablo is getting on the home that he purchased. So those would be the four sources of inventory for us.
All right, buddy. I'm going to cut you loose so that we hit the right timing for the first time ever out here. I just want to say, we try to get to as many questions as we could, but we go through this and, the team goes through and combs through the questions. We'll reach out to you if you have your data in the registration from the Zoom link, if there's anything that we can help you with. Also, easy way to get some really good answers. Go to our Facebook group, jwbfacebookgroup.com. Easy way to find it. And join over 2,000 other investors that are in there that are in the cool club. Used to be the secret cool club. Now it's not so secret anymore. But guess what? You're in, whether it's a secret or not. So I also want to say we had over 60 people on this call today. Never goes without notice that people take an hour of their day to spend it with us, Gregg and I here, to give you as much value as we can. It's really, really means the world to me. And next Tuesday, we've got a great guest. Gregg, you want to tell them about Alyssa?
Alyssa is an incredible, we'll call her a JWB veteran. She's been with us since the very early days. And I always really have a special place in my heart for those who invested with us, who trusted us before they saw a lot of the success, or before they saw that we actually have, an office building that can house 80 people and all that good stuff. Alyssa was an early adopter, and incredible. Her and her family have invested with us, and a lot that we can learn from her journey. If you are somebody who's kind of heard that you can buy rental properties in your retirement accounts, Alyssa has done that. She's also come up with creative strategies to do that we can talk a little bit more about. She is somebody who cares tremendously about neighborhood revitalization. So I've already gone and taken a look at some of the neighborhoods that she's invested in early on, and we're going to get to see how those have been transformed from her investment along with other JWB clients, completely different now. And I know she cares a tremendous amount about that. So it's going to be a really fun, I think, engaging conversation because I know her. And I think for those of you who kind of have similar goals and are similarly passionate about neighborhood revitalization, you're going to feel really good about this chat with Alyssa.
Well, Gregg, I don't know what it is, but I feel good about chatting with you, buddy. So you did a great job today. Thanks for everything. Thank you all for coming. I'll leave you with the last word.
Thank you again, everybody. These Thursdays really are a blessing for Pablo and I. We get super excited about it. I think this has been the highest attended Thursday Property of the Week show that we've had. So thank you so much. If you know somebody that would be interested and you think would benefit from this type of an experience, we would love it if you would share this either on social or send an email out to register for the Zoom call. It's really easy. You can send people to www.nyais.com, nyais.com for notyourAverageInvestorShow.com. And let's see if we can continue to grow the community with like-minded folks. So thank you all. Hope you have a great rest of the week, and we'll catch you on Tuesday.